So Taxman, we all are aware of. Of course, we as a professionals, as even department have started using Taxman from all the sides. So that's kudos to Taxman for growing at a great speed. And also allowing us to have a platform where we can share knowledge to all our fellow members. So thank you very much for allowing me to give some brief about family succession and tax implications in relation to that. I'm sure this is going to be useful because what I'm now going to speak about is only in relation to the practical aspects which are applicable when we do a succession planning in practice, and what are the tax related issues in relation to that, right? So let's start the journey. The practical answers is what we are going to discuss, and I'm going to cover the real case studies which we have dealt with. uh, First, I'm going to speak about what are the growth drivers, okay, for a family business. And in case if the growth drivers are not being handled and maintained successfully, then of course that leads to separation. And in case if of separation, then in that situation, what are the tax implications which may arise if you do a estate planning or if you do a family succession planning, etc. So that's what we are going to discuss in another 50 minutes, and then we'll be having Q&A. This is basically what I'm going to speak about is there have been a case study which was done in detailed, and around 7 family businesses were considered. And this is what the outcome of the family businesses were. So one of the outcome was that family businesses for unrelated diversifications to cope up the poor communications and structure. So the study was done for the large family businesses, and one of the outcome which they could see is that because of poor communications, there is a lot of diversification which happens into the business, right? That's one. The second thing is that largely the decisions are taken on a majority poll. But if the majority poll is not successful, in that particular case, the decisions are taken based on based on the low risk profile. So there where the risks are less, that's where the decision happens. Or otherwise, there is always delays in decision. So that's another problem which a family business has. Third problem which the family business has is trusteeship. So what is trusteeship? Basically, there is always a mentality of maintaining the family image, family brand image, which is earned over the years by the predecessors, and that needs to be continued. And we act as a trustees. That's what is the mentality which the family business owners and the elders have, and that results at times, not every time, but at times it results into young generations may not be able to cultivate new ideas and take new risk in the business. Youngsters on the other sides generally are very ambitious. They look modern technologies and they want to grow in a short time, and the existing business managed are the existing whatever businesses are there, those businesses are managed by outside professionals. So on one hand, they are having limitations of taking risk. Their inquisitiveness for growing is very high, but on the other side, the existing business are managed by the professionals, and that is one of the very important reason why the young generations are not intending always to come into the business, because they have a great entrepreneurship as a part of their young generation career, right? So because of those entrepreneurship, they are interested in taking risk. They are interested in growing fast. However, on the other side, what happens is, because of the factor of maintaining the brand image, and also because the existing business is largely managed by an outside professionals, there is less space available for them, and as a result of that, there is generally a young generations who doesn't get involved into the business, into the family businesses. This is one of the factor which is noticed when a survey was done for the large business organizations. Now, what is the solution? The solution which they derived is that family businesses with great level of professionalisms, okay, it's very important both in the business and family are likely to perform and perpetuate better over a long period of time. So professionalism, of course, is required. Large business families are likely to approve new investments in the diversified areas in small amount to test, and ideas first are considered, and then of course if the ideas works well, then of course significant investments are made into it. So that is also one of the way of encouraging the entrepreneurships of the young generation, so that there can be new business diversifications which are possible to generate. There has always been a saying that third generation is the last one to manage the family business and continue to have family business. Generally, fourth generation is where the family business dies. That's been the that's the general saying in the past. But that is something which, if it is being structured and professionally managed, then that becomes to be a myth. Entrepreneurships into a green project. So what happens is, if suppose the family members are groomed to manage their existing business after their studies, then in that particular case, that entrepreneurship bubble which grows around is something which is well balanced, because they are managing the existing business which otherwise are not managed by the professionals outsiders, but they themselves are managing it, and at the same time there is a balance between the entrepreneurship and the management of the existing business. New ventures are likely to encourage in the business, right? Because that's very important. When existing business are managed by outsides, leaving limited opening for the senior level for the family members. That's something which needs to be balanced out. So it should be having a professionalism also, but at the same time, it is important that we are also managing, we are also allowing the existing family members to manage the business and not completely leaving it to the outsiders. In family business, where family members are competent managers, professionals finds the so this is one of the other factor, where if the family businesses are managed by the family members itself, then the professionals who are outsiders who have been elected, okay, if they are not having that mutual respect between the family members and them, then they find it little conducive to work, and it becomes difficult to draw synergy. So what is important is that kind of culture and that kind of respect has been created, mutual respect has been created between the outside professionals and the family members, so that there is good level of communication which happens among the members and the outsiders, and a business can grow. So these are some of the solutions which were been suggested, where to summarize, the one of the major problem which arises in the family business is because if the whole business is managed by an outside professionals, then there is no space which is available for the new generation members to do the business. So therefore that space should be provided, and a portion of the management skills of the young generation entrepreneurs should also be utilized. That's number one. Number two is that the investments which is to encourage the entrepreneurship skills of the young generation can be encouraged by allowing them to have their projects on this ideation level with small amount of investments, which can always be increased if it has been successful. So these are two of the solutions which are important, which I thought we need to bring it into our family business, so the young generations are inspired and encouraged privilege to continue in the existing business. However, having said that, if that is something which is not happening, and there is a need to have a family succession being planned, or if there is a need for having a family business getting separated, in that particular case, what should be the tax implication which one should keep in mind? That is something which we will be discussing in the next part of the session, right? Now, let me start with a private trust. Now, we all are aware about that in case of a private trust, when these private trusts are being used. So the private trusts generally are used in a situation when you don't want to give the assets directly to the beneficiaries, A. B, you are not very clear about what should be the distribution share of the beneficiaries on those assets. So today, if you're not sure about that, then that is also one of the reasons why you will create a private trust. Number three reason is that there is a protection, because if you create a will and do a succession estate planning, in that case there is no protection to the assets, like from the liabilities. However, if you want to protect the assets, in that particular case you need to create a private trust, because that's an independent entity, independent status, and therefore that particular assets will be protected from any future liability which may come upon you. So that is the reason why we will go for a private trust. One of the other reason also which is noticed in case of a private trust is that when you don't want to disclose that who is managing a particular business, then in that case also a private trust is been set up where the trustees manage the business, which could be an internal family member also, but that is not getting disclosed because that is not publicly available as an information which otherwise is available when we talk about the company. So when a company, the shareholders are disclosed, who is managing the business is disclosed. However, when it is managed by a private trust, who is managing the private trust as a trustee of the trust is something which is not getting disclosed. So that's also one of the reasons why a private trusts have been formed. Right. Now, let me give you one case study which talks about the tax implication in case of a private trust. Now, let me take this example where there is a private trust and the private trust is registered in India. Right now, there are beneficiaries. One of the beneficiaries is in India, and one of the beneficiaries is a resident of Hong Kong. I'm sorry. And let's also understand that this trust has income assets located at both the locations. So there is an assets which are there in India, and there are assets which are also there in Hong Kong. Now, if we analyze the tax implications of that, then the beneficiaries, because the beneficiary is in India and he is having 50% share, because it's a determinant trust. Determinant trust means the share of the beneficiaries is defined. So your 50% of the share is of an Indian beneficiary and 50% of the share is of Hong Kong beneficiary. Mind you, the trust is registered in India. Right now, what will be the tax implication? So tax implication will be, because the trust is going to be defined their residential status based on the beneficiary status. So as a result of that, the Indian beneficiaries would be taxed on the Hong Kong income to the extent of 25%, 25, because Hong Kong income is totally 50. But because Indian beneficiary is having 50% share, therefore he will get 25. Similarly, Indian income, which is there in India, of that 50% belongs to Indian beneficiary. Therefore, that is also going to be taxable. Now, when we go to beneficiary of Hong Kong, the beneficiary who is residing in Hong Kong, for him, Indian income will be taxable because it is accrued in India. So 25% of the Indian income is going to be taxable for Hong Kong beneficiary. But the income which is generated in Hong Kong for that Hong Kong residents is not taxable in India because that's a non-residential status. So if we see at a total level, at an aggregate level, the tax which a trust which is a private trust which is going to pay in India is going to be 75 in this example, which is more. Okay, because there is certain portion of Hong Kong income which is also getting taxed. Now, let us understand the practical application of this. Now, let's say there is a family which is holding assets in India and which is also holding assets in overseas. Now, there are some beneficiaries who are in India, and there are some beneficiaries like children who go outside India for studies, who get settled down outside India. So they don't want to come back to India. In that case, those beneficiaries are residing outside India, right? So there are beneficiaries who are outside India. Now, if we form a trust in India, where all this assets gets cumulatively considered as a part of this particular Indian registered trust, and if the beneficiaries are in India and in overseas, then we are eventually paying a higher amount of tax. However, there is a possibility that if you have two trusts, that is where I'm now going to take you across. So let's say if you have two trusts, if you have assets in India, and for the Indian assets and for the Indian beneficiaries, you are having Indian trust, and that is going to be operated from for the assets which are located in India, and therefore only Indian income is going to be taxable for the Indian trust, for the Indian beneficiaries. However, for the beneficiaries which are located outside India, and for the assets which are located outside India, you can plan where you have a foreign trust getting registered, as a result of which the foreign income will not be taxable in India for the foreign beneficiaries also, right? So as a result of this, what happens is you are having a tax planned where the Indian trust is managing the Indian assets for the Indian beneficiaries, and a foreign trust is managing foreign assets for the foreign beneficiaries, and both are having separately been taxed separately, and there is no co-taxation as far as both the countries are concerned. So that's one kind of a tax plan which can be legally managed. That's number one. Now, what this leads to tell you about what are the tax implications about the trust, private trust. Believe me, this was something uh, before I was there, as I was there associated with this subject. Before that, this was something which was an optional subject for me, frankly speaking. But when I'm been into this particular subject over the years, this is the core summary of it, and that's what I have brought it over here. Now, what the core summary says, it says that if you are a determinant trust, okay, the status of the trust will be the beneficiaries. Okay, the status of beneficiary to the extent of their share. So let's say if a beneficiary A is holding 20% share, then 20%, right? So beneficiary to the extent of their share will determine the status of the trust, right? Because it is determined and the rates are specifically defined. In case of a discretionary trust, where the discretion of distribution is absolutely with the trustees, right? Then in that case, it is beneficiary to the extent of their share. But if the beneficiaries are different as far as their status are concerned, then the status of trustee will be considered. Right? We'll come across the foreign trust separately. I'm just right now first focusing on the private trust, Indian trust. Now, how the residential status is defined? Again, the same philosophy. If it is a specific trust, then it is beneficiaries to the extent of their share. And if it is a discretionary trust, then again the same beneficiary. But if the beneficiaries have different residential status, then the status of the trustee will be considered. Now, mind you, as far as the status of the trustee in this portion is concerned, there is no legal backing as such, but this is generally a practice which is being followed, right? Now, taxability in the hands of, so who will be taxable? So in case of a determinant trust, trustees or the beneficiaries, okay, that can be taxed. In case of discretionary, it is if the income is all distributed, then the beneficiaries or trustees, either of will be taxed. But if the income is not distributed, then the trustees will be taxed, right? Rate of tax, because it's a determinant, specific income is getting distributed. Therefore, beneficiary, as if beneficiary individually are being taxed, whatever is the rate over there, that rate will apply, except for a business income where it is MMR which will apply. In case of a discretionary trust, this is the difference, where the discretionary trust, irrespective of what is the tax rates for beneficiaries, the MR rate will apply. So if your beneficiaries are located at different locations, right? In that particular case also, it is an MMR rate which will apply. However, in case of a specific trust, it is going to be the rate applicable to beneficiaries. That is the rate which is going to be applied, right? So this is a sum and substance as far as the private trust taxabilities and residential status are concerned. Now let me take you to the foreign trust. I'll just give you a very small glimpse of it so that you can refer it to it as a ready reckoner whenever you come across such kind of situations. If it's a revocable trust, then Indian settler, and say irrevocable trust is basically where the assets are transferred but they are revocable, and therefore an Indian settler will be liable for tax on the income which is generated by the foreign trust, because the Indian settler is operating that particular trust. If it's a revocable trust where foreign settler is there, in that particular case, the beneficiary status will be considered and they will be liable for tax to the extent of the beneficiary's share. If it's an irrevocable trust, then what is important to note is that who is operating that particular trust, because it's an irrevocable trust, it's a foreign trust, and if it is operated from India, so if the place of effective management of the trust is in India, then it is considered as a resident trust and therefore worldwide income will be taxable. In case of an irrevocable trust where the assets are transferred with an objective of not recovering those assets back, in that particular case, it is going to be a foreign and Indian beneficiaries. Okay. And Indian beneficiaries will be taxed on the distribution. So that's what the sum and substance of the foreign trusts are, the taxabilities of foreign trusts are. Broadly, if we see, if it's an irrevocable trust, more or less, if the beneficiaries are Indian, then the beneficiaries will be taxed on the distribution. However, if those foreign trusts are completely managed from India, and if the place of effective management is in India, then in that particular case, its worldwide income of those foreign trusts will be taxable in India. That's about the irrevocable trust. That's broadly the substance of the foreign taxation of the foreign trust. Now, why this is important is because nowadays there are a lot of foreign nationals, foreign citizens who have been earlier the Indian nationals, and they have shifted to foreign countries, and now they have their assets lying in India and they want to plan those particular assets. So of course, one of the things which they have been doing is they are liquidating those assets. That's something which is natural, which have been seen. But there are clients who want to manage and maintain those assets, but they want to ensure that those are managed and the beneficiaries are able to take the benefit of that. That's where this is going to come into play. In case of an HUF, the simple case study which I would just like to share is that in case if there is an HUF, and if the HUF have number of members, co-partners, right? And if they decide that now we want to come out of the HUF business and do the individual business, or they decide that they want to distribute the assets of the HUF, then what happens? Now, in this example or in this case study, a real life case study where one partner wanted to move out, and therefore he decided to take cash. When I say cash, it is of course through banking channel, but he decided to take cash from the business, from the HUF assets portfolio. The other partner decided to take property. The third and the fifth partner decided to continue the business. Okay, so they wanted to continue this particular business of the HUF, and the fourth partner actually passed away, and therefore the share of the fourth partner was actually to be transferred to the legal heirs, right? the question was that how do we do this? How do we plan this particular estate of the HUF? And therefore, the number of options were evaluated, and finally the question arose is that in such situation, what should be done? Should it be partitioned, or we can do it without partition? And therefore, of course, the general question which comes to mind is whether gift received from HUF is taxable under section 56 or not. And therefore, this question was there since long. It is there since long till date, and there is a lot of conversations which is happening beyond in this particular reference. There has been a favorable argument where it says that yes, it is gift, and the gift from HUF should not be taxable. And there is also an argument which says that HUF giving gift to members is something which is not allowed. And therefore, there was a matter of litigation going around this particular corner. So what finally was decided is to partition this particular HUF and let the number 3 partners and number 5 partner, number 3 and number 5 member continue the business in their individual capacity, but at least as far as the HUF is concerned, let them partition and then distribute the assets between them, so that as far as the total partition is concerned, when that is getting distributed as a part of total partition, then it is not liable for tax on both under section 45 and under section 56, right? Now moving on to the next point, which is basically for partners. Earlier was the story where there was admission, retirement, etc., and there was change in the partnership, and there was an option available where you could withdraw the profit without there being any risk of taxation relatively. But now, after the provisions of section 45(4) and the provisions of 9B getting introduced, there is a change. So let's first understand what this provision is talking about, and then we go on to how do we identify a solution for it. Now, in this case study, let's say there are 2 partners, both are unrelated partners, and partner A wanted to transfer his share in the partnership firm to his son. Partner B, whose name is Sayyam, wanted to transfer the share to an outsider. So what decided generally is Sayyam will get a property worth of 1.5 crore of the firm, and he will get 50 lakh in cash against the capital of 1 crore. So he's having a capital of 1 crore, and against that he's going to get the assets worth of 2 crore. Right? Now let's understand what is the tax implication as far as section 9B is concerned and 45(4) is concerned. Now, first of all, 9B will not be applicable when it is a transfer of share, partnership share from father to son. 9B or any of the tax will not be applied because that is straight transfer from a father to a son. However, when we go to Sayyam, when he's transferring to an outsider, there are 2 parts to it. One, because the asset is getting transferred by a partnership firm, therefore a normal provisions which is applicable for a partnership firm will apply. So as a result of that, it is going to be that fair market value, which is of 1.5 crore, okay, and cost of acquisitions, which is of 1.2 crore, the differential amount of 30 lakhs is going to be taxable, right? That is going to be one tax implication because firm has transferred the asset to a partner, and therefore this is going to be one tax implication. The second implication is that the partner has withdrawn over and above the capital. So whatever capital he was having of 1 crore, he has got an asset worth of 2 crore. Therefore, 1 crore additional, which he has got as a part of capital, as a part of income. Therefore, the firm will also be liable to pay a capital gain on this 1 crore, which additionally he got. Now, since you have already paid tax, where the firm has already paid tax on 1 crore additional, which is got by a partner, that 1 crore is going to be distributed among other assets which the firm has, and their value of other assets will get increased in the proportion of their value in the block of asset. In that particular proportion, this value will get added up, and whenever those assets are sold, the incremental cost will be considered for the purpose of capital gain, right? So that's what is going to be the overall tax implication in the new regime of reconstitution of the firm. Very simply, if I narrate it, it very clearly says, first is it is going to be, because the asset is getting transferred, there is going to be a tax. Second, because there is going to be a amount withdrawn which is more than the capital, there is going to be another tax, which both the tax will be paid by the firm, right? Now, is there any solution? One of the thought process where one of the case we came across, where a partner was actually getting this particular asset, but he was intending to sell that asset in his individual capacity. So what we suggested is that instead of he selling it, taking over the asset and then selling it, if he sells it within the partnership firm, okay, whether it is going to be beneficial. And when we evaluated, we found that yes, it is, because at the end of the day, the fair value of the property as it is 1.5, the firm is anyway going to pay tax of 30 on 30 lakhs as a capital gain. But this 30 lakhs is at the end of the day going to get distributed among the capital of the partners, and therefore their partners' capital is going to get increased. And as a result of that, the partners' capital, which in our example right now is 1 crore, which will be increased by 1.1, increased by 15 lakhs. So under section 9B, when he pays tax, under section 9B, when the tax is going to be calculated on capital gain, that is going to be reduced by 15 lakhs because the capital of a partner is increased by 15 lakhs. So that is something which was legally possible to do, and that's something which could be done, because at the end of the day, the intention of the partner was not to hold the asset. The intention of the partner was to anyway liquidate the asset and encash it. So the idealistic situation was to liquidate it within the partnership firm and then take away the funds. That would reduce the tax implication, right? Now, let me take you to the last case study of the today's session, where the case study is talking about will versus family arrangement. Now, if you see the case study, what the case study is talking about is there are total. So A is a person who is the main person who holds this assets. So he was holding 99% of the shares in a company. He was having company B, where he was holding 60% of the shares. And there was an LLP where he was holding 60% of the profit sharing ratio. And then others, as is mentioned on the screen. Now, the important part was, how do we plan the estate so that a member of the family are able to have justice, and they are able to have a arrangement wherein there is less number of dispute which may arise in future. So there is no emotional turbulence which may come across over a period of years. That was important, because whenever you do an estate planning, the first factor which you consider is that should not have any emotional disturbance in future, right? And therefore, since there are two people whom the assets was supposed to be distributed. One is the brother of A, and second is wife of A, right? How do we do that? So CLLP is a manufacturing hub where all the business of B and A were manufactured, and A and B are the selling companies who were holding licenses. So in a way, both companies were playing critical role. A and B on one side because they were holding the licenses, and C because it was having a manufacturing units, and all the manufacturing of A and B were happening at C. So therefore, idealistically, the first the while the will was created or drafted, uh, a brother and wife both were given shares in A and C equally. So the whole idea was that if they are able to work together, then both will be able to have the benefit of each company net worth. But at the same time, there was one conditional clause which was mentioned, where at the time of execution, if A and C, sorry, if the brother and wife are not in a very strong terms, then the executor was given a particular direction that the wife will continue with A company on a conditional basis that she is ready to leave the rights on company C. So company C becomes an independent company which is managed by brother, and company A is managed by wife, and as a result of that, there is no emotional interference which will be created at the future date. So that is something which becomes very important when you do an estate plan, and that's the reason why this case study was selected, so that we can actually ensure that the wealth is getting distributed, but at the same time, emotional turbulence is not getting created. Here, one also important factor which was there is that in case if the executor executes it, at that point of time, A is holding the shares, which is an independent company, mind you. A is holding the shares of C. So there is a sharing which is there in C, which is by A. So when A transfers the interest in C to the brother, there is an independent transactions of transfer which may attract taxation, and therefore that is one limb which was supposed to be covered from the taxation perspective, and that is the reason why a family arrangement was a far favorable option as compared to will. And why is that so? I will just narrate it to you. Number one reason was, in case of a family arrangement, whenever there is a distribution of asset among the family members as a part of family arrangement, then it is specifically exempt under Section 47. So that's number one. Number two is, because you do a family arrangement, all the members are being brought under confidence, and then this particular arrangement is done. So as a result of that, it gives less number of chances of any dispute in the absence of Mr. A. So that is also the second reason why family arrangement is better as compared to will. But generally, what we have been seeing is that at the stage where Mr. A ends like people, when they are planning their estate, they don't want to create any disturbance among the family and his presence. And therefore, the choice is left with the benequet, that whether he would like to uh, do a family arrangement wherein in his presence there is clarity which is there among the family members, or he would like to execute a will which is as per his wills, and if it will be left on the executor later on to distribute among the family members where there are likely chances of their creating a disputes. So that's of course a choice which is there with the family, with the person who is preparing the will. In our example is Mr. A. So with this, I think this case study is something which I have just brought it to your notice. Finally, what was executed over here is that wife will hold company A, which is 99% share, company B, which is 60% share, and company D, which is 40% share. One of the reason why we gave these three companies to wife is because here the functionality of manufacturing is not required. Second, there is equally a outside partner who is available for execution, and as a result of that, wife can get the benefit as a shareholder and need not have to get into the regular affairs of the business. So that's the reason why this planning was done, and the brother was equally given the share in the manufacturing plant, which was held and owned and majoritively will handled by him. So that's the kind of agreements which we had entered finally to ensure that both of them are getting the benefit of that. I think this was the last part of it, and I think I'm done with my part of the presentations. I hope everybody have got some benefit out of it, and they would be able to take this particular presentation as their reference point when they come across any kind of planning in future. Last but not the least, basically this is one WhatsApp group which is for a tax and FEMA subject, where the group of all the chartered accountants, around 500, 600 chartered accountants come together, and they share each other's query on the particular group, and the group is helping each other to solve their queries. So the objective of the group or the community is to share queries, ask queries, and then get the answers from the group. So with this, if anybody would like to be a part of the group, then they can scan it and join to the particular group. With this, I think I am resting my presentation, and I'm opening the floor for questions. It is 5:40, 5:47, and we can discuss upon the questions and then conclude the presentation. Thank you very much. We can raise the questions, please. I'm opening the floor for questions. So I am seeing one question which is raised by Mr. VK. Can you recommend a book on succession planning? VK, I'm specifically I'm seeing that there's a lot of diversified topics which are covered in different books. So not a specific book as such which will be talking about all the subject is what I can come across. But yes, there are multiple books which have been discussing upon on a diversified subject as far as family plannings are concerned. And there is a lot of literature which is also available on the browser, which is helping us to have the guide about the questions or the queries which we have. There's one question from Mr. Mohit which says, say there are two brothers, A and B, running a business in a partnership firm. If A wants to exit the firm and take the fair market value of the asset, okay, can Mr. A gift his share to Mr. B's wife, okay, and get her as a partner? Can the continuing brother, Mr. B, pay Mr. A his share in the firm over and above the capital balance via a gift from the brother to save the taxation on capital gain and revaluation exercises? Okay, so I'm assuming over here that Mr. A and Mr. B both are family members, and that's what it's not need to be an assumption, because you have mentioned also there are two brothers, A and B. So between A and B, both of them are actually swapping the share, wherein Mr. A is handing over the shares to B's wife, and in turn Mr. B is paying the share, Mr. A, his share in the firm. So here what is important is you are saying that can the continuing brother, Mr. B, pay Mr. A his share in the firm over and above the capital balance via a gift from brother to save the taxation on capital gain and revaluation exercise. So here, I believe when you say that you are paying over and above, so then in that case, it is not a gift which is happening. But what I would suggest is we can evaluate it from the perspective of family arrangement, because they both are brothers. And because there is a separation which is getting planned, where this business is something which you want, you are intending that Mr. A should give it to B, and in turn Mr. B pays off the money to Mr. A, I think you can consider it as a part of family arrangement to work it out so that you are taking the benefit of that. But yeah, this is a specific query. I would like to evaluate this query and come back to you. Maybe you can share your email ID on the chat box so that I can come back to you on a specific answer rather than giving you a general answer to it. Now there is one more question from CA Achal, which says, on the death of a partner, if his share of profit transferred to other person, will there be any tax implication? So when you transfer the share among the family members, then I don't see a reason of there being a taxation, because it is a part of inheritance which is going, and therefore there is no need to have a taxation because it is by way of inheritance. Yeah. Achal, in case if you still have a question, of course, you can raise this question to me. Now I think you're saying if the other partners are unrelated. Okay. So on the death of a partner, if his share of profit gets transferred to other partner who is unrelated, okay, will there be any tax implication? So basically, Mr. A is a partner, and there is Mr. B who is unrelated partner, and you are transferring the share of Mr. A to Mr. B. So in this case, Achal, can you please unmute yourself and say whether Mr. A, when the legal heirs of Mr. A, are they going to raise any question over here? Are they going to get any consideration against it, or it is going to be a mutual understanding wherein the shares of Mr. A is going not to legal heads of A, but it is going directly to the outside partner or an external partner? Are there going to be any sharing of consideration? And if not, then there is no tax implication. But if yes, then yes, there is going to be a tax implication. So you can either unmute your query, or you can raise this query separately. I'm going to share the screenshot is also available of the WhatsApp group, or you can also share your query to me, or you can unmute it over here. Achal, you can either unmute yourself or you can raise your query on the WhatsApp group.
Sir, the audience may not unmute themselves, so they need to post their questions in the chat box only.
Oh, they will only be able to do it on a chat box. Okay. Yes. So until then, the question is that whether the partner who is unrelated, is he going to give any consideration to the legal heads of the first partner? No consideration. In that particular case, there is not going to be any tax implication, because there is no benefit which is getting transferred to the legal heads of the partnership. What is the stamp? Yeah, Achal, you can raise any further query if you have. In the meanwhile, I'm taking a query of Mr. Sandeep, where he's asking, what is the stamp duty implication for family arrangement? So here, when in case if there is going to be a property, immovable property, which is getting transferred, then there is a tax stamp duty implication while you do a transfer. Of course, earlier there was a different view that whether because it's a part of family arrangement, whether there is going to be a stamp duty or not. But at the time of registration, when you actually do it, you will be having a stamp duty implications on that. But at the same time, I would suggest, Sandeep, I would also like you to see whether this particular thing, when you do it, also understand the state laws, because there have been some states where this particular arrangement is not considered for the stamp duty. So they have exempted it because this family arrangement happens between the family relatives. So that is also one of the factor needs to be considered while you are evaluating it, because it is a states which also defines whether between the relatives, when there is a property getting transferred, there are some states which are not having stamp duty implications. So that is something which needs to be evaluated. Now, there's a query from Mr. Abhay. If the shares is given through will, then no tax. Yes, because it is by way of inheritance, therefore there is no tax. But what happened? Abhay, I believe you are also referring to one of the case study which I was speaking about. In that case study, what was happening is Mr. A is having a will, and a private limited is a separate entity. That okay. So as a will, I can transfer my portfolio of assets to the legal heads, but I can't transfer under the will the assets which are of a separate entity. So if it's a separate entity and the shares of that entity is supposed to be transferred, then that is not happening directly under the will, right? The will can be only in relation to my assets. So if you are asking a question from a perspective that whether in my case study, whether it was through will, the answer is no. There is a tax implication because A Limited is a separate entity which is transferring the shares to a brother. But generally, if you are asking me, as a part of will, when you are inheriting your shares to somebody else, there is no tax implication. Is there any more question? Yes, there is some more question. One question is from Mr. Sandeep, which says, in case of a personal will, the testator leaves assets to wife. State after death of wife, assets will go to a trust. Okay. However, testator dies before creating the trust. Okay. Can the wife will the asset received under will of husband to another person, since the trust is not formed? So second part of will of husband is not valid. I'll read this question one more. In case of a personal will, the testator leaves asset to wife. Okay. As a part of the will, I believe, and the states after death of wife, assets will go to the trust. Okay. After the death of wife, the asset will go to the trust. Okay. However, testator dies before creating the trust. Okay. Can the wife will the asset received under will of husband to another person, since the trust is not formed? So second part of will of husband is not valid. Now, I believe here, Sandeep, we need to go detailed about the will. What are the wordings which are given in the will? So what was the intention when this will is created by husband, and whether the on the death of wife, this particular assets, whether it is specifically mentioned the beneficiaries of the trust who should be taking this benefit, that is something which needs to be looked into, because if they have specifically mentioned about the beneficiaries, then the will has the husband has already in the will clearly presented his intention that it should go to wife, and in the absence of wife, it should go to the beneficiaries. So that if it is clearly mentioned, then that needs to be looked before the wife giving asset to somebody else, right? So that is one paragraph which needs to be looked into. And I'm sure when this will was created and it is mentioned about the trust, they may have referred to some beneficiaries into it, because that it is clearly you are mentioning in your query that it is on the death of wife, right? The asset will go to the trust, which is already mentioned in the will of husband, and therefore their beneficiaries must have been mentioned. And if that is mentioned, then the wife cannot transfer to somebody else, right? Now there is a query from Mr. Vijay.
It's 6 o'clock.
In case of partnership partition of HUF, do we need to submit to AO, and how to do it now when nothing is attached with the IT returns? So there is of course a communication which is possible, Vijay, because there is a jurisdiction assessing officer who is available, and therefore in case of a partition you need to give that partition document along with a covering letter to the assessing officer mentioning your action of partition, right? What will be the status of family arrangement being made where company, partnership firm, proprietor and properties, legal sanity under the different act for this kind of arrangement like Companies Act, partnership, stamp duty and such and such? I'm trying to understand your question, Vijay. What will be the status of family arrangement being made where companies, partnership firms, proprietary business and properties under different act for this kind of arrangement? What will be the status of family arrangement being made where companies, partnership firm, proprietor, this under different act for this kind of arrangement like Companies Act, Partnership Act, Income Tax, Stamp Duty and such arrangement? Vijay, I'm just still trying to understand your question. What will be the status when you refer to status of family arrangement being made where companies, partnership firm? So I'll break this. When you say family arrangement where companies, so there is a company and the shares of which are held by the family. Of course, those shares will get transferred among the family members, and therefore the status of company will continue. And the share might have got transferred to the family member as a part of the arrangement. Same is for a partnership firm. Proprietary business, I don't see there again being a change, because at the end of the day, it is between the family where they have agreed to change the ownership of the entity. As far as the entity is concerned, it still continue to remain the same. As far as the stamp duty, as I said earlier, stamp duty is going to be between the family members. So each state-wise, the stamp duty law has to be checked into. Income tax, because it's a specific exemption available under Section 47, if the family arrangement is genuine without any malified tax avoidance intention, then that is not going to be considered for taxation. You have a question, what will be the cost in the hands of retiring partner when he sell the asset, fair market value or cost to the firm? Abhay, you are asking what will be the cost in the hands of retiring partner when he sell the asset, whether it will be fair market value or cost to the firm. So here, because you are paying tax, because the firm is paying tax at fair market value, therefore fair market value will be considered to be the cost for the retiring partner. So Sandeep, you said there are no beneficiary mentioned at all as the trust had, as they had no children. But then what was the objective mentioned in the trust? So trust was supposed to be created for what? That is something which is a question. Sandeep, I think you need to chat this with me offline, maybe through this WhatsApp, or I'm just dropping my email ID and you can send me a query on this particular email ID so that I can answer your query. But I believe that needs to be seen little bit in detail. Vijay, you have said this is in between one group only, having all above parameters in arrangement. Uh, this is in between one group only, having all above parameters in arrangement. So I believe you are referring to this particular query where family arrangement is between the family members, where companies, partnership and proprietors are there, and it is between one group only. I believe that does not make a difference, because even if it is within the group, since you are having a family arrangement which is getting divided between the family members, I don't see there being any concern, but I believe you have a specific concern around it. In case if you have some specific concern which is not demonstrated over here, you please send me a question on my email ID. I'll try to help you out over there, or you can even join to the group. Vijay and Sandeep and Abhay, thank you for asking these questions. I'm sure I have helped you to answer it, but in case I have not been fully justifying my answer, please come back to me on the email ID and I'll surely help you out for it. Mohit, you have shared your email ID. I would just request you to share your query on the email so that I can answer you that. Yeah. With this, I hand over the floor to Komal to take it forward and make the announcement if there are any. Thank you very much once more, and for having this particular hearing of the presentation. Thank you very much.